Assalamualaikum warahmatullahi wabarakatuh. My name is Zaima Wafi binti Zulkifli.
Assalamualaikum warahmatullahi wabarakatuh. My name is Eda Rufana binti Ismail.
Assalamualaikum warahmatullahi wabarakatuh. My name is Noor binti Khairul Azmi.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nofarhana binti Muhammad.
Table of content 1.0 is Introduction, 2.0 History of HSBC, 3.0 How HSBC manage its risk from market risk, operational risk, credit risk, liquidity risk, and reputational risk. 4.0 is Conclusion.
Alright, this slide is about the risk management in Islamic banking. So first we must know what is Islamic banking. According to Islamic Banking Act 1983, Islamic Bank is a company that runs an operation does not have any haram element that prescribed by Islam. So what the objective of the establishment Islamic Bank? The objective is to fulfill the financial needs of Muslims in particular and the country in general. Okay, all Islamic banking has managed to risk. So what is risk management? Risk management is the process by which various risk exposures are identified, measured, mitigated, and lastly reported and monitored.
HSBC presence in Malaysia began in 1884 when Hong Kong and Shanghai Banking Corporation Limited set up their first office in the country on the island of Penang with permission to issue banknotes. In 1959, it bought Mercantile Bank, which began operating in Malaysia in 1860. During 1999, HSBC opened its office in Malacca, and by the end of 1912, they continued to open their office in Ipoh, Kuala Lumpur, Johor Bahru, and Kota Bharu.
Before I go into HSBC market risk, I will explain the market risk first. Okay, market risk can be defined as the potential financial losses suffered by financial institutions due to market price movement. Means market price up and down, which is out of control. And the objective of market risk is to manage and control market risk exposures to optimize return on risk while maintaining a market profile in line with the established risk appetite. There are two types of market risk. The first is trading risk and second is non-trading risk. But the main market risk that exposed in HSBC is banking book interest rate risk and foreign currency risk. So how HSBC monitor and limiting market risk from exposure? The first is sensitivity analysis, second value at risk, and the third is by stress testing. Sensitivity analysis. Function of sensitivity analysis is to measure the impact of individual market factor movement on specific instrument or portfolios. Second, value at risk is a technique for estimating potential losses on risk positions as a result of movement in market rates and price. And last is stress testing. Stress testing is the most important procedure that is integrated into the market risk management framework to appraise the potential impact on portfolio.
Okay, let's continue with the operational risk. Actually, operational risk is a risk of loss coming from a failure or inadequate internal process, system, people, or sometimes external event. As I mentioned earlier, these factors is always make the operational risk arising in some institution. Sometimes activities such as violation, system flaws, activities of terrorists and vandalism also affected the risk in some Islamic banking institutions. There are some process risk management by HSBC. First, increase monitoring and improve detective control to manage the risk of fraud arising from new technologies and new banking methods. Second, improving a better control and security to protect customers when they are using digital channel. Third, enhance control in terms of ensure that we know our customer monitoring transaction concerned by detect and prevent financial crime risk. How HSBC manages operational risk in terms of online banking. First, HSBC provide PIN-protected security device which may help to protect client personal and financial data from any risk. Second, HSBC also use industry-level encryption for strong data encryption. Because of that, all the sensitive information such as credit card details will only be readable by the banks. Third, HSBC also provide automatic timeout features for all the client of HSBC, meaning that the client will automatically log out from online banking session after a period of time, so they doesn't need to worry about their personal information or account. And lastly, HSBC also provide SMS notification for all transactions made by the client.
Okay, let's start with 3.3, which is credit risk. What is credit risk? Credit risk is the possibility of loss resulting from a borrower's failure to repay a loan or meet contractual obligation. Okay, from the HSBC, credit risk of HSBC is the risk of financial loss if a customer or partners fails to meet an obligation under a contract. It arises particularly from many contracts such as direct lending, trade finance, and leasing business, but also from off-balance sheet products. For example, guarantees, credit derivative, and also from the group holding of debt. Okay, let's see credit. What is credit risk management? Okay, credit risk management is based on four principles from IFSB guidelines. First, IFI should have a strategy for financing. Second, IFI shall carry out a due diligence review to the prospect partners before deciding the choice of an appropriate Islamic financing instrument. Third, your IFI should have appropriate methodologies for measuring and reporting the credit risk arising under the Islamic financing instruments. And the last one, IFI shall have in place Sharia compliant credit risk, appropriate technique for the Islamic financing instrument. Okay, let me continue with 3.4, which is liquidity risk. What is liquidity risk? Liquidity is the ability of a firm or even an individual to pay its debt without suffering losses. Instead, liquidity risk comes from the lack of marketability of an investment that can be bought or sold quickly enough to minimize loss. Okay, it is designed to be adaptable to changing business markets and regulations. Based on HSBC, liquidity risk is the risk that do not have enough financial resources to meet the obligation as they fall due. Liquidity risk arises from the discord in the timing of cash flows. Okay, let's see what is liquidity risk management. HSBC has an internal liquidity and funding risk management framework, which is LFRF, which aims to allow it to withstand very severe liquidity stresses. Okay, next, IFI should have in place a liquidity management framework, including all of the reporting taking and overall databases liquidity exposures in each category of current accounts, risk-trade and unrisk-trade accounts.
Today we are going to explain about reputational risk. Reputational risk can be defined as the risk of unexpected losses due to stakeholder reactions triggered by changed perception of the company. Reputation risk management involves anticipating, acknowledging, and responding to change values and behavior on the part of a range of stakeholders. Reputational risk is the risk of failure to meet stakeholders' expectations as a result of any event, behavior, action or inaction, either by HSBC itself. Okay, so it means that reputational risk is something that we have to lose with unexpected, and it is involved by anticipating, acknowledging, and responding to change values and behaviors of the client on these stakeholders. Okay, the CRO companies is responsible to the CRO companies group. Reputational risk community is responsible to provide advice and feedback to senior management in order to keep our company to be a good one. Next, reputation risk causes and effect. So the first one is reputational risk is commonly understood to mean situations of confusion that can tangle the good reputation or some way minimize it. It means the reputational risk is commonly that we understand as a confusion to us, but it is actually a risk to that company, to certain company. Second, we may infer that credibility risk is often viewed as a risk of declining importance that rising value. And the last one, the perceptions of clients and our relationship with them are damaged by how much our conduct is different from their expectations. For example, when the employee is expecting their salary to be higher, but when they came into the company and got a job into the company, the salary is beyond of their expectations, so they will be disappointed with our behavior, and it can damage the reputational image in our company. The conclusion of this case study is all about HSBC risk, which consist of credit risk, liquidity risk, market risk, operational risk, and reputational risk. By knowing all the risks, we know that this company HSBC Bank have their obstacles to grow up the company, and they will think their own way to go through to all the risks. Okay, if we don't have an exact plan, like HSBC did not have exact plan for their company, it will lead them to be a bankrupt. And a well-developed risk management mechanism is to detect any future harm to HSBC Islamic Bank portfolios asset quality, whereas a temporary problem. That means we can detect any harm in the future, and we can get ready when the harm is come to us. And the last one, efficient risk management capabilities are important for Islamic banks like HSBC Islamic banks, whereas to put themselves strategically in the volatile world market in order to make their their bank to be the good one, to be the worldwide bank. They have to manage their risk efficiently, and they have to plan their risk. They have to plan their strategy to overcome the risk. Thank you.